Welcome to Central Bank Central. I'm Kathleen Hayes. There is so much going on for the Federal Reserve right now, so much that it almost seems like their next policy meeting. Now, it's not till March, nevertheless. Whether it's going to be a cut, a pause, who knows, seems to be like one of the least of the questions. A new Fed chair will be coming in the next few months. The big question, where the Fed is heading, what kind of pressures will be put on it, what will come from new Fed officials, and more. So I'm very happy to bring back to Central Bank Central James, as in Jim Bullard, former president of the Federal Reserve Bank of St. Louis. He was there from 2008 to 2023, the longest serving Fed president in history. Also was then and still is considered a respected scholar leader in this field. And now, of course, he is at the Mitch Daniel School of Business, Purdue, and busy there, but taking some time out for us today. So, Jim, it's great to see you again.
Great to be here.
So, like I said, a lot going on, but let's start with the simple part because the last time I saw you, before the end of the year, you were looking for possibly one rate cut this year. Is that still the case, or are there enough questions about, both sides of the dual mandate, not just the inflation, but also the jobs and the labor market that you've had second thoughts?
No, I think they're headed for one more cut, and I think it would be in the second half of the year. And so I would stick by that. I think it'll be a good year for U.S. economic growth for all the reasons Wall Street analysts have been citing, fiscal policy, tailwind, AI boom, uh, reasonably strong consumption. And I think, tariff uncertainty, we can talk about that, but I think still under control here. So for all those reasons, I actually think it'll be a good year for growth. And then on the inflation side, I think, um, inflation's continuing to hang up higher than the committee would like, and that's going to make them reluctant to move too quickly. And so I think that all adds up to about one rate cut during the year.
Do you think there's any chance it won't be cut at all? I mean, some people have even
Oh yeah,
started to say, not
no,
exactly looking for a
there's
hike, but
uncertainty, could go a lot of directions, but I'm just saying based on the data today and the outlook today, that's what I would guess.
and so inflation is stuck, if you look at the core, up around 3%. That's well above the 2% target for the headline, but it's still, I think people figure that's where you got to get to eventually. Um, what what do you think of inflation expectations at this point? You are somebody who's argued for a long time. These are very important. Fed credibility. How long can you stay up at this above target rate and still get everyone convinced that you're really serious about getting inflation back down to 2%?
Yeah, I would look at tips-based inflation compensation. That seems to be in reasonably good shape in trading over the last month or so. So I think those numbers there are the ones that you would expect if the market really was expecting inflation to go back to 2%. So I think that's very comforting for the committee. They would like to see actual inflation be coming down, but for a variety of reasons, there might be sticking up a little bit higher. So I think they'd like confirmation on that before they make any moves.
Well, but yeah, the problem I always have with that, humbly, my problem, I'm not a former Fed official, PhD economist, but it's people who buy things. It's people whose expectations seems to me are count because those are the people who are going to say, well, I guess I'm willing to pay more prices, right? And at some point, well, I guess I'm going to need to ask for more wages. And could look at that part of it because if you look at the University of Michigan survey, one of the more controversial ones, nevertheless, the oldest survey of expectations in the country, you see stuff that is stuck at a higher level. Um, what do you make of that part of it? Is that something you're watching as well?
Yeah, I mean, if you look at the theories there, they have price setting behavior by the firms. So the firms, in a grocery store, they have to decide what price they're going to put on their product on the shelf, maybe some coupon discounts or something in certain situations, but they've got to make that pricing decision. So that's posted pricing. The consumers, of course, coming into the store, they want the lowest that they can get, and good for them. But I think it's expectations of the businesses. What do they think they can raise prices or not? If they thought they were in an inflationary environment, they might raise prices consistently every quarter to keep up with that. That happened during the 2021 inflation. But if they think that inflation is going to go back to 2%, then they'd be very reluctant to raise their prices because they might lose customers. And if they do lose customers, cost of customer acquisition is very high. So it's very hard to get those customers back. So I think generally speaking, they're kind of reluctant to raise the prices based on the expectations that are out there. They're always reviewing their pricing decisions, of course, and they also have to consider regular, sort of bread and butter supply and demand, of their product and what innovations are occurring in the market and everything else. But with respect to inflation, it's probably the business expectations that are the most important. So you could look at those. There are surveys of business expectations, and I think they've been, if I'm recalling my chart correctly, I think they've been drifting down a little bit. But I like the market-based expectations because the market is taking all of that into account, including the Michigan survey, including the business expectations, and then they're making bets on what they think will happen to inflation, looking at all that data, and they're putting real money on the table. So I think it's an information aggregator to look at actual markets for inflation expectations.
So how about the labor market? The jobs growth has come way down, but of course, population growth is low. We've had the deportations, we've had the big drop in migrants coming into the country. So a lot of people say supply and demand. How do you look at it? What is the natural rate of employment growth? I mean, at the levels we're seeing now, do you think, oh, that's another reason to be thinking about cutting rates? Or do you say, no, the labor market is different, at least for now, and it's much more about inflation and some of these other factors?
Yeah, I think an important piece of research was done at the San Francisco Fed, and they've recently blogged about that. And it's a detailed study of immigration, undocumented immigration from, let's say, 2021 till now. And excellent analysis, a lot of detail about where workers might go, what kinds of industries they might work in, what the rate of growth and rate of decline in those places has been. And they found almost a one-to-one correspondence between the change in immigration policy and the change in labor market employment growth. So I take that as what we've witnessed over the last few years is almost entirely due to supply factors coming from immigration policy, very rapid growth during the earlier years in this sample. And then as you come into 2024 and 2025, much less or negative growth or much less growth because the immigration policy changed. So I think that's very informative about how we should think about non-farm payroll employment. We have been thinking, a good number is like 150 or 200 or 250 or something like that. And we're used to those kinds of numbers, but I don't think that's what's happening going forward. If we keep the same immigration policy that we have, then I think you should expect only 30,000 per month. And I even today, even though this argument's been made a lot and people have been talking about it a lot, I'm not sure the market has really adjusted down, their entire expectations about what they think a typical jobs report should show us. Also, you'd expect some negative numbers in there. The variance hasn't changed, so you'd expect some negative numbers in there, and that's supposed to be okay. That's supposed to be consistent with the normal growth of jobs in the economy, given the natural variation in the data. So all of this makes me think that the unemployment rate maybe takes outsized importance here. It's always been important, but since non-farm payrolls isn't really giving us the same signal that it did, should probably look at unemployment, and that's been ticking down. And unemployment insurance claims also showing very low levels. So I think that probably the best interpretation is that the labor market's in pretty good shape, given the new immigration policy that we have, and the
Okay.
economy is probably doing pretty well.
Just have to ask this here. Um, AI, okay? The a lot of discussion on AI, artificial intelligence is productivity, so how much it's going to boost it, this year, next year. That's another thing that could have an impact on the Fed's policy decisions, right? More productivity, higher growth, you can afford to be still on rates. But and you're Purdue, you're at the business school, Mitch Daniel's business school. So let's just start with what do you see any signs? Can anybody expect to see any real valid signs of what AI is doing in terms of jobs, in terms of productivity as well?
Uh, no, I think it's a great technology. It will enhance productivity. So that part I think is absolutely true. We actually put in an AI requirement here for all undergrads in the business school, and now that's been adopted by the university as a whole. So everyone's going to be versed in AI that's graduating from here. So I think it will increase productivity. I think it will be like a lot of the other great technological changes that we've had over many decades and centuries, even in the US, and it will enhance worker productivity ultimately, and that will allow workers to make more. Wages will be higher for an hour of work because they will be more productive. So I think that's exactly what's going to happen. These kinds of doomsday scenarios that are laid out, you know, they don't take into account if you really thought everyone's going to be unemployed and down and out, you won't have anybody to sell a product to. So that can't be an equilibrium. That can't be a good prediction to make. The value of the labor is going to change depending on how much they're using the new tool or not using the new tool. And I think that's the way to think about this. So I'll just give a simple example. So we've had a lot of snow
Okay.
here this winter.
We've got it
So,
too.
so suppose I have a snow removal business, and all my guys use shovels, and they're great, and they use shovels, and they're good customer service, and it's a good business. You invent the snowblower. So what am I going to do? Well, I'm going to adopt the snowblower. I'm going to use less people to shovel all this snow, and I'm going to have a more productive business, and that's going to settle
Okay.
down into an equilibrium. So that's exactly what's going to happen here. It does mean that some of my shovelers are going to have to go get different jobs. They're going to have to move to different industries. But the history is that new jobs are created in other ways, in other places that wouldn't have been there previously. And that's what's going to happen again this time.
Growth, GDP, what do you expect there? You are still looking for this rate cut, maybe second half of the year, so not immediately. You're waiting to see what happens. But there's some pretty positive views of GDP this year, right? And if growth is strong, if the unemployment stays at this a low kind of level, um, even if payrolls don't grow as fast, then what then?
I think we'll get 3% growth this year. When all the dust settles at the end,
Mhm.
by this time next year, we'll know that number. But um, I see no reason why it wouldn't be a very strong year in terms of GDP, real GDP growth. Um, I think the labor market accordingly will continue to have a relatively low unemployment rate. I would say the current rate is very close to what most people would estimate as the natural rate of unemployment for the US. And so that's going to keep the committee, waiting to see if they get the additional disinflation that they've been waiting for a while. And unless they see that, I don't think they'll come down any much further or any further on the policy rate. That's why you got to wait till the second half of the year to see that develop.
So if productivity is going to be increasing and the economy is stronger, isn't the maybe the neutral rate higher than the majority on at the FOMC thinks that, and so maybe you don't really need it. I guess that's what I keep wondering. What is the reason, especially if inflation hasn't gotten a lot closer to 2%?
Yeah, I think you know, uh, to the extent there is greater productivity growth, and it's hard to measure and it's very volatile, but to the extent it is higher, then that would increase the neutral rate. So if the committee stands still and the neutral rate's going up, then that would be a more dovish policy. And so they may take some on the committee may take comfort from that they don't actually have to move the policy rate in order to get a little bit easier policy. But before they would move further, they've already moved 75 basis points here. So I think they want to see how that's influencing the economy and especially inflation.
You said you'd like to comment on tariffs. I'd like you to comment on tariffs too. So, the Supreme Court just called Trump's tariffs a reach too far, made him abandon them. He has a 150-day fallback position to reinstatement. Seems like there's a lot kind of being stirred around there. Um, so it's really not clear how much change this implies. What do you think of this and what it does imply, and what it ultimately may mean for inflation? I think it was your former director of research, Chris Waller, who just said a couple days ago that he didn't think that tariffs had that much impact overall, in this period. Uh, what do you see happening there with this? Well, first of all, it makes things more uncertain, but second of all, what does it mean for prices? What does it mean for businesses setting those prices?
Yeah, I think Governor Waller's right that this has not had nearly as much influence on inflation as people were predicting earlier. Um, I think there's a variety of reasons for that. I think the Supreme Court decision was widely anticipated. This is something that had been talked about for a good 6 months at least, or 9 months even. And I think most people that looked at it, uh, both lawyers and non-lawyers, but when they looked at it, it just didn't look like Congress had really delegated this much authority to the executive branch to set tariffs. So, most people seem to think it was going to be very hard for the Supreme Court to say that somehow the Congress had really delegated this much authority. So the decision came out as expected, I think, and without too many um, prescriptive additions to that. So I guess they sent it back to the lower court for that. And then the administration also, I think, anticipated that this might happen. And they were ready with their backup plan, and that's what we're seeing right now. So ultimately, I think it's not changing things too much. You can talk about effective tariff rates and stuff, but I think the main issue is that tariffs are still here, and they're still relatively, similar to the way they were. And so for that reason, you didn't get much market reaction to this entire sequence here.
Okay. Want to ask you about the other big change that's facing the Fed is not, as I said, not just what they're going to cut rates or not. In fact, sounds like they're pretty much close to, well, maybe they'll do one more time. So it's going to be a big change. But we've gone through this bout of attacks on Fed independence and the uncertainty that caused. A new Fed chair is coming in. Um, we'll have Kevin Warsh potentially, probably, and replacing Jay Powell. So with all the different things the Fed has to face now, who matter who is going to be Fed chair, um, what how do you think things might change? How should they change?
Well, Kevin Warsh does seem to have support in the Senate. I'm not sure he can pick up bipartisan support, but he seems to have support in the Republican caucus. So it seems like the administration has to either use their available seat and use that and get Kevin Warsh confirmed for that seat, and possibly to make a deal somehow in order to get Chair Powell to step down from his seat. But my reading of it is that he's not too inclined to step down from his seat. He's been very circumspect about what he would do. I think he wants to possibly remain on the board to protect Fed independence, and may see it as his historical responsibility to do so, since it's
Jim, I want to stop you there because I want you to continue. This is very interesting to hear you say this, but I want you just tell people exactly what you mean with the seats on the Board of Governors, right?
right.
Versus
On
the
the Board of
12,
Governors,
because yeah.
there are 7 seats on the Board of Governors. They're all occupied right now. So in some sense, there's no openings right now. But you have Steve Moran. He could step down, and his seat has actually expired. He's working overtime, I guess. His seat has expired, so but he can continue as long as no other person is confirmed. But they could confirm somebody for that seat, and that seat has a long term on it now. I guess 14 years.
14
So
years,
that would
yeah.
be the one to use for the Fed chair. So that could be done, but there's a blockade in the Senate, as you know, with Senator Tillis voting with the Democrats to not allow this. So they're going to have to make some deal. Of course, deals can be made, but they're going to have to make some deal to break that blockade. And then you've got the issue of, would there be any other seats that would come open in the near future? And the only seat that seems likely or possible is Jay Powell's seat, which has 2 more years to run. And right, I'm saying that he doesn't seem very inclined to step down from that seat because he wants to protect Fed independence, and he's worried about the future of the Fed. So I think to get that to happen, you would have to reassure the chairman that Fed independence was going to be protected, and they've been obviously fighting with the administration so much that trust is broken down there. So it could well be that the chair will stay on in his seat, and even though Governor Walsh gets confirmed for the other seat.
Well, so, I just want to follow up on this a little bit more because it's interesting to me the number of people I've asked in how long, the past 6 months, however long this has been going on, right? And former Fed officials, certainly at least one very blatantly, would he stay on longer? Will Powell stay in the seat as on the board as one of the governors as opposed to the chair? And the answer was only if he's masochistic. In other words, people figure it would just be that he would be continue to be bashed by the president, and it just wouldn't be worth it. It's interesting to me that you see a strong possibility that he will decide to stay. Is it something you know about Jay Powell himself? Is it something, I guess you laid it all out, very worried about central bank independence and preserving it.
Well, you know, not to put words in his mouth or anything, and it's certainly his decision, but if he leaves and Fed independence crumbles, he would go down in history as the guy who allowed Fed independence to crumble. So I think that is the calculus there, is would he allow that? And probably he would not. Now, would he, if Kevin came onto the board and was chair, would he interfere with that? I don't really think so, except that he would have a vote on monetary
Policy.
policy and other matters.
Yes.
And so he'd probably be a moderating voice on that. But I don't think his idea would be to disrupt the Kevin Warsh agenda. His idea would be to protect, he would stay on to protect Fed independence. And if you're stepping down out of the chair role and into a governor role, that's a simpler, it's not as big a role, and he could probably play that role pretty well.
Another just quick follow-up then. It sounds to me like you're saying, or do you see that kind of potential uh, threat and risk to the Fed? Lisa Cook, it looks like, Fed governor who's been put on the hot seat before the Supreme Court, seems to be in good shape. And do you think do you think there's really still going to be that much attention, particularly when Trump gets a new Fed chair, that is still going to be a big issue that current Fed officials, former Fed officials like you, many people who are so supportive of Fed independence would be on the lookout for and actually thinking there's maybe a need for him to do that. Jay Powell, that is, stay on.
Uh, well, there's been so much acrimony that if it was a situation which is a more typical situation for an incoming administration, they wouldn't have been quite so acrimonious in fighting with the Fed. Then, and I think in many cases, the governors will just say, well, okay, let's let the new president go ahead with his agenda and appoint the people that he wants to appoint. But here there's been a lot of acrimony, and also a lot of transitions are relatively smooth because the uh, agenda of the incoming person is basically, continuous with what the outgoing person was doing. So Bernanke to Yellen, for instance, even though that was a switch of parties, there's a lot of continuity there, and you're promoting the vice chair to the chair, and they had worked together, and certainly were pretty supportive of each other's policies. So, and again with Yellen to Powell, I think a similar situation. But here you've got a relative outsider who's been a critic of the Fed. And so that's a different sort of transition that we haven't seen in a while. Maybe, you might point to the Volcker Greenspan transition possibly as something like that. Certainly the biggest one of post-war macro history is the G. William Miller to Paul Volcker. That was a very traumatic change in leadership at the Fed, but that was that's a sort of special case and very volatile era. So I don't think we're in that situation, but you do have this kind of less continuous sort of transition going on here compared to what we've seen in the last couple of events like this.
Yeah, I want to ask about a very specific thing that apparently the Trump administration's been talking about, and that would be something you know well, near and dear to your heart, requiring district Fed bank presidents, that 12 regions across the country, the candidates to have deeper roots and a longer pre-appointment stay in their proposed district in order to qualify for a selection. In other words, you can move to New York, one day and, 6 months later become the president of the New York Fed, et cetera. You were the president of a district bank. I've always been so supportive of the district banks. I think they're very important. I think the research, I think the independence and not being just all in Washington, D.C., et cetera. What do you think of that as a requirement? Would it be helpful in some way?
I've been a little bit puzzled by this. All the people that I know of, you're hired by your board of directors. They are prominent people in that district, business people, bankers, others in the district. They want you to be, they want you to be in the district. So you're definitely going to live in the district. And you're not only that, but you're going to get to know the district very, very well because the bank has a natural outreach program across the district. So I think it's a little puzzling that you would restrict ahead of time who can be in the job. Some people might have, maybe they don't live in California at that moment, but they might have lived in California previously, or
Mhm.
and once you want to do a national search for a position of this level of prominence, I think the usual thing is when you do a presidential search, you want the very best person that you can get, and you're going to weigh everything, including whether they're from the district or not. But you're going to also weigh many other factors and trying to get the best chief executive that you can for that bank and for that operation. So I find it a little bit puzzling to try to restrict everything that much.
Well, Jim Bullard, any thought you want to leave with about where the Fed heads next, how Purdue's going to do. Are they going to get to the NCAA playoffs, the March Madness, etc.?
Uh, Purdue is in the top eight, so they should have probably a number two seed as of today in the NCAA tournament. They have beat a lot of top teams, but they've also lost to some. So I think they're very competitive. And then the tournament, you never know what's going to happen. So we'll see.
Okay. Well, we'll be watching closely.
Yeah.
Okay. Well, Jim, thank you so very much. Thank you for taking all this time. Hope to talk to you again soon. And I'll be seeing you in Washington, D.C. in April when the Shadowhood Market Committee has their annual meeting. That'll be fun.
Looking forward to it. Thanks for talking.
Okay. Thanks for talking to me. Jim Bullard, he is former president of the Federal Reserve Bank of St. Louis, and he's the head of the Mitch Daniels School of Business at Purdue. I'm Kathleen Hayes, and this is Central Bank Central.